Good morning. Well, this should be an interesting week. Election, Fed meeting, jobs report, all inside of 5 days. What could possibly go wrong, right? So, one of the things that you're seeing within equity space right now is a very, very chronically elevated level of volatility. And so when you have a high degree of volatility, what it does is it increases chances and odds for big swings in market pricing in both directions. Years and years ago, I used to work with a guy that always, when market volatility would expand and markets would act towards moving into a bear market, he'd start growing his beard out. He'd call it the bear market beard. I don't know if it's a bear market, or I don't think that it is at this point. S&P is in bearish trend. The Russell 2000 is in bearish trend. But that doesn't necessarily mean it's ready to crash. It just means that it's in a position of being bearish trend. So that's why we're very, very underweight any type of equity at this point. We've got a little exposure to utilities. We've got a little exposure to real estate. And we have a little exposure to home builders, which all three of which happen to be in a much better setup or trend. However, with volatility being elevated the way that it is, it creates a situation where we just have to endure and deal with some volatility. Market's pricing in a lot of different potential outcomes and possibilities right now, and it still is that tug of war between that quad 3, quad 4 going on, even though we do have a bit higher probability of stagflationary quad 3 type characteristics. So that being said, it is very much about the U.S. dollar. The dollar right now this morning is trading at 94.15, which is the very high end of the mathematical calculus for the day. We would anticipate, based on the movement of the dollar, to start to come down. When that comes down, that has a tendency to make all the other asset classes that are out there, from the S&P to oil to gold to Bitcoin, commodities, you name it, do better. And the reason is because of these embedded inverse correlations that exist with the U.S. dollar. So as the dollar goes up, lots of asset classes struggle. As the dollar comes down, lots of asset classes do better. Some have asked what in the world, why we would think the dollar is going to go negative on us or start to continue to trend down. And the answer is just the nonstop degree of federal stimulus, Fed support, you name it, that goes on. And we've talked about how we think the Fed's kind of in a bit of a bind. This weekend's Barron's magazine cover had a picture of Fed Chairman Powell on it that said winner. I laugh because we usually use magazine covers as a contrarian indicator. Whatever the magazine cover says, we probably want to consider or do the opposite. So does that mean the Fed's a loser? And the answer would be it's stuck. It's proverbially pushing on that string. In other words, the stimulus capacity that the Fed has a tendency to throw into difficult environments may not work the way that it has in the past. Very much uncharted waters right now in terms of the current economic cycle and the way in which the central banks across the globe are responding to the slowdowns and whatnot that have gone on. So I'm going to share just a couple of quick charts with you, and as I do that, I will try to explain just the basic positioning that we're setting up for and why that makes sense. So this is a picture of an exchange traded fund symbol UUP, which is a representation of the US dollar. And you can see that the US dollar is tapping the top end of the mathematical calculus for the day. And so we certainly would anticipate, with this kind of a bullish move having gone on, to reverse. The last time we had that kind of bullish move, you remember, was in September. And we talked about how the likelihood of the dollar reversing would be pretty strong, and certainly it did. We think we probably will see something similar to that in the near term. Volatility measurements continue to be elevated, but even though it's starting to come down just a little bit, you can see it's trading at 37. And with equity volatility, specifically VIX, S&P equity volatility, anything above 30 is what we would deem elevated. The calculus of the model today has it going potentially anywhere from 28.5 to 43. 43 VIX would feel, for most people who are heavy in equities, extremely, extremely uncomfortable. we would be in a position of making decisions at that point in terms of whether or not it's an opportunity to buy, or if VIX appears to be going higher. If it's going higher, then what that does is it negatively impacts price. And so because of that, we just have to be judicious considering all the external potential impacts that exist in markets today. With the U.S. dollar signaling overbought, it gives you an opportunity for positioning yourself in other currencies that are extremely oversold. FX, world currency, is actually one of the safer plays that exist in markets today because volatility of currency these days is not tremendous. Certainly doesn't look anything like what equity volatility looks like, and it doesn't look anything like bond volatility. The MOVE index continues to be up over 60. When the MOVE index is up over 60, what that means is that you have a high degree of volatility in treasuries, in bonds in general. And that makes for very large price swings. And so we have to be very careful of volatility entering into marketplaces. And so therefore you get an opportunity to work into lesser volatility elements in portfolios. And one of the ways to do that in terms of positioning yourself as to how the dollar is moving is utilizing other currencies across the world today. And so one of those is Swiss francs. And so therefore we've got a position that we're building in Swiss francs. You can see that the calculus has it in a very low end of the mathematical range. We're adding to it down here, and the anticipation is that we could see it move up into this range as the U.S. dollar continues to drop. And so if the U.S. dollar drops down into this calculus, which we believe is a high probability event, that'll continue to move in our favor. So bottom line is that right now markets are continuing to give us some signals that are very quad 4 deflation. For example, I'll show you one real quick, which happens to be oil. You can see the deflation that has taken place in oil in just the last couple of months. Oil's down about 18-19% since the beginning of September. And deflationary elements within hypersensitive commodities like oil is very quad 4. However, that's the only element that is giving us a quad 4 picture. Everything else, inflation is certainly there and picking up within the ag complex and things of that nature. So we continue to position ourselves within a quad 3 type stagflationary position with a very high degree of protection in place because of so many uncertainties that are out there. And so we're building positions, as we discussed, in things that will do well with an expanding yield curve. So as the 10-year Treasury moves up, as the 2-year Treasury moves down, the yield curve steepens. When the yield curve steepens, what that does is the market's anticipating a greater degree of economic activity at some time in the near future. That has a tendency to do well for one of the holdings that we have, symbol IVOL. So we're adding to that. If interest rates on the 10-year Treasury, and I'll share that 10-year Treasury picture with you here real quick. If interest rates on the 10-year Treasury get back up into this range, in the 0.88, 0.89% range, that would be a very high end of the mathematical calculus over the last several days, and it would give us an opportunity, I think, to add to our TIP position, which is Treasury inflation protected securities. And those kinds of things do better in quad 3 than longer dated treasuries. But we'll see. We're not fighting the Fed. We're working towards front running them based on what the likelihood is that they will or won't do in terms of stimulative measures and things of that nature. So safer areas certainly are cash, certain currencies that work against the U.S. dollar. We believe the U.S. dollar is ready to move down. That'll certainly help some positions that we've got in place. And a down dollar is, with embedded inverse correlations in the market, actually good for lots of asset classes. So once some of these things start to ferret themselves out and we get more towards a growth-oriented quadrant within the economic sine curve, that's when you'll see us get much more aggressive in our positioning. Right now, it really is about protecting the value of the portfolio and keeping it away from high levels of volatility. And as I mentioned, volatility is still exceedingly elevated. I'll share one last chart with you that just shows some of the volatility measurements. So here's volatility going all the way back to March. Here's where it is today. you can see that we didn't have the degree of volatility that we've got today until the beginning of March, end of February. Now, that's not to suggest that volatility is going to go here. However, the calculus is continuing to give us what we refer to as a higher high. And when you get a higher high in volatility, what it does is it expands the probability of larger movements in the equity market in both directions. And so there's good and there's bad, but that volatility has a very difficult place in terms of protecting the portfolio if in fact prices go against you. So we have very limited equity exposure right now, and I'm going to maintain that very limited level of equity exposure at least currently. As volatility shifts and some of the volatility of volatility measurements start to shift, then I'll make some adjustments to help minimize exposure to the wrong things at the wrong time. And then those things that we start to gross up, we're doing so simply based on what the math is suggesting and based on what has historically done well within the current economic quadrant that we're in. So I don't believe that at this point we're heading into a crash. I don't believe that we're heading into this massive negative level of bear market activity, but we are currently in bearish trend in the S&P 500. Bearish trend in the S&P 500 is a time series of 3 months or more, but more importantly, it's dictated simply based on what volatility is doing. If VIX is north at this point of 28, then that's north of trend. If it's north of trend, that causes the index to be in bearish trend. So if VIX is in bullish trend, then the index is in bearish trend. And all that simply means is it gives us the greater probability of large price swings, in some cases in both ways, but with a bearish direction, a bearish bias. So that's why we have to be a little bit more cautious in these kinds of environments. It's just where the regime of volatility is currently trading comparative to the market. That's all. So our holding periods, if we do have equities, have a tendency to shorten up a little bit. We want to try and take profits smaller. We want to try and help minimize any downside movements as best as we can with the obviously within the context that there are a lot of narratives that are out there, and we want to ignore those narratives and focus on the math. Right now, math is suggesting that that even though VIX is elevated, it appears right now that it has decided that it is trending. Episodic and clustering is one thing. Episodic and trending is another. And a trending degree of VIX to the upside creates a bullish VIX movement, creates a bearish trend in the market, equity market that is. So therefore we want to focus on those markets that do not have the same kind of volatility. So that's obviously some of the currencies that I've talked about, cash, which is helpful to some extent, depending upon what happens ultimately with the dollar and its movement. Being able to short the dollar here gives us an opportunity to create some upside opportunity. And then within the commodity complex, notwithstanding oil, like I talked about. So yeah, that's kind of where we're at. We're just taking it one day at a time, letting the math dictate exactly how we position and move ourselves. And we'll continue to do that as we get through this. Ultimately, this current economic structure will shift. And once the market decides what it ultimately wants to do in terms of the direction, that'll give us some indication on a much higher probability movement from one quadrant to another. Right now, it's a coin toss. It's quad 4, it's quad 3, and it keeps going back and forth. Last week, we had several quad 4 days. Will we this week? It's hard to say. If volatility keeps coming down, that's good in the equity market. If volatility in the bond market keeps coming down, that's good. We've not seen that break or come down yet. If gold volatility stays fairly calm, that's good. We have a gold position. So those are the pieces of the puzzle currently. If you have any questions, let me know. Direct line 608-354-1977 and email chris@careformywealth.com. Always super thankful to work for you. I apologize if some of these things get a little bit complicated sometimes. I really am trying to help explain what the movements are doing and why. My radio show this last week, I think, explained in pretty great detail the focus and the interconnectivity that goes on with price to volatility and why we watch and track those so carefully. So if you get a chance, shoot over to the website, careformywealth.com, go to resources, click on radio show, and there's a podcast there either at iTunes if you're an Apple user, or at iHeartMedia, which is a downloadable podcast. So until then, hope you guys have an amazing day. God bless, and thanks very much.